Hello, Benjamin. How are
Doing
you?
wonderful. How are you, Christy?
I am fine, thank you. Welcome to the Legacy Years podcast. So, we talk about all things embracing the joys and challenges of aging. And I think what I really hope and what I hope to do with every episode is provide tips and valuable information that can help folks do just that. And I think when we talk about challenges, that finances are certainly one of them. So I'm very excited to have you today on the podcast and to talk about all things
Well, I
annuities.
appreciate you inviting me, and I'm excited to hopefully offer a little bit of insight that you and your listeners can find valuable.
Good. And I certainly think that you will. I always think it's kind of funny because I feel like what I do, which is reverse mortgage planning, and what you do with annuities, I know you do a lot of things. It's a little synonymous in the way that the public has perceived those over the years. And I think that just like our industry has changed and brought about some great consumer protections for that product, so has your industry. So I'm looking forward today to telling folks how annuities work today, maybe why they should consider doing an annuity as part of their retirement planning. So let's just dive right into it. So, can we talk a little bit about the different types of annuities that there are?
Absolutely. I think similar to, over the landscape of financial services, you look 20 or 30 years ago when annuities were first introduced. They were this revolutionary new tool that a lot of folks were really excited about. Insurance carriers had come out with this ability to create an insurance-based product that leveraged investment components, but with certain guarantees that were built in. The challenging part for that was, one, there were a lot of variety of different annuities, and second, the cost
Okay.
of those guarantees and that coverage usually carried a hefty annual fee or charge to it. And the public pretty much soured on those for a long time because it almost became a taboo topic that, oh, annuities are always very high in fees and they're out to get you. And what's misplaced is over the 20 and 30 years that they've been around, the entire annuity landscape has completely transformed, that it's nowhere what it is today, what it looked like 30 years ago. So I think that's one important part for clients to know is the annuities and the different varieties of annuities. You have lots of different annuities, some in the fixed space, which means that they give a interest rate that's not tied to the market at all. Typically, those type of fixed annuities are more correlated to similar instruments like CDs, certificates of deposits that you can buy at a bank. And then you have
Right.
income annuities, and income annuities provide a guaranteed stream of income. The one that's most akin to that folks can usually, when we sit with clients and help them see the similarities, is Social Security. The fact that you get a paycheck every year for the rest of your life, no matter how old you live, that's essentially what income annuities provide. Is for a lump sum of money, the insurance company takes the risk of providing that income stream and taking away longevity as that risk component, meaning income keeps coming no matter how long you live. The last area of annuities that's really evolved more than the first two has been in what they would consider the indexed linked annuities or variable annuities. Now, I should also preface that, of course, as we discuss topics that involve securities, you should consult with your financial professional, licensed and registered provider. This shouldn't be construed as any financial advice. This is just an educational
Okay.
component. As we all know in our industries, we always have to give those extra.
Absolutely.
But with registered index linked annuities, as well as for variable annuities, the ones today have actually a lot of features that cost no fees at all. So a lot of carriers have realized clients that want these features but don't want to have to pay the fees on them, they've been able to restructure and redesign these for zero fees. And instead of zero fees, what you're hedging is a little bit of the performance inside the equity
Hmm.
space. So for clients, it allows them to basically hedge that maybe they don't want to be exposed to as much market risk, and they're willing to lose a little bit on the market risk and the market reward component in exchange for the buffered safety component that annuities offer, or the income stream later.
Got it. So when you think about an annuity and you think about whether or not you want to put something like that in place, when should someone be thinking about that? And I'm assuming maybe it's a little different depending on how they fund the
Yeah, there's
annuity.
no silver bullet like that. This is always when you should fund an annuity. It really is a case by case scenario. Typically, most annuities are placed when clients are in their 40s, 50s, or 60s as alternatives for rollovers. So they've got an old 401k and they're looking to preserve that money and grow it for retirement and won't be touching it. Then they'll defer it inside of an annuity to get those growth components, but not necessarily have to roll it into their new 401k. And then you have pre-retirees that start realizing maybe they don't want all of this market risk associated with their typical investments. And what they'd rather build in is some guarantees or buffers that provide a modicum of resistance or resilience to market volatility. And then also during retirement, a lot of retirees have identified that they don't want any market risk at all, but they still do want growth on their savings. And annuities provide that opportunity. And annuities have a certain tax advantages related to them.
So when you think about someone's overall retirement plan, this is just a part of it potentially. This is not, hey, we're going to put all our money in this basket type of
Yeah, I mean,
thing.
as the old adage says, don't put all your eggs in one basket. A lot of times, annuities are a great tool as part of a retirement plan, but not the only retirement solution. So, most holistic advisors are leveraging components that and features that annuities offer as part of that retirement planning solution. They're not overly putting the majority of the assets necessarily in the annuity, but they also aren't excluding annuities either, because they have some great features that just traditional investment accounts don't offer.
Got it. And when you think about the payout, so you set the annuity up and then do you wait? Do you get the payout right away? Like how does all that work? And when you think about over the course of your retirement, I mean, you may be talking 10, 15, 20, 25 years. Does that annuity keep up with what inflation might, bring about in terms of cost of
Of course,
living?
it depends on the annuity. There
Okay.
aren't any kind of carte blanche that all annuities will hedge for inflation or hedge for rising interest rates. So you would have to identify which annuity solution you're preparing for a client. And a lot of times, if that is something you want to keep up with, if inflation, which is of course one of the blind spots during retirement that you want to make sure to cover,
Yeah.
you want to make sure that those annuities are taking that in consideration, because there are inflationary features built into a lot of these incomes streams from the annuities, or in the growth metrics for the annuities. But to go to your earlier question, which was how do you then create income? The typical
Yeah.
method, and there are two phases for an annuity. The first phase is the accumulation phase, and during that, that's when money is being invested and stored and growing inside of the annuity. And the second phase is called the annuitization phase. The annuitization phase changes the lump sum that has been accumulated and then starts providing it as a stream of income or distributions. And those options vary from annuity to annuity. There are many different
Okay.
iterations of how those income streams can be provided. Some can be provided over a specific time period. We have some annuity solutions that we provide clients that says this is going to be your income from age 60 to age 75, and we're going to try to maximize your Social Security by waiting as long as possible. That's one solution.
Okay.
Another is the flip side of that. Let's go ahead and exhaust what other benefits or resources you have of maybe a 401k or maybe some retirement savings, and defer that at starting at age 75. Starting at age 80, the income from an annuity would then start kicking in. Similar to Social Security, the longer you defer an annuity, the higher the guaranteed income could be off of that annuity. So it really depends on the solution. But annuities offer all of those options to the clients that purchase them.
So that brings up an interesting point when you think about aging. None of us know how long we're going to be around. So let's say a couple sets up annuities. Is it, are there rights of survivorship? Is it, how does that work? Is it, oh, they're going to get it as long as one of them is still around, or is it an individual type of
Yeah,
thing?
annuities actually operate with multiple payout options. The first payout
Okay.
option, which can sometimes be the most deleterious, is where it's a single life only. Meaning, if my wife and I were to get an annuity and it was a single life only, it would offer me likely the highest monthly or annual payout. But after I die, there's no money being passed on. You can also do a life with cash refund, which offers the highest payout. But then, if I, for example, had deposited 100,000 in annuity and then taken out 20,000 in income, then the difference of that is a cash refund to the beneficiary I chose. Of course, as I mentioned,
Oh,
was my wife. So then I can be at least guaranteed that the 100,000 I put in, at least it was either given back to me or the remainder passed on to who I designate. You can also have period certain, which identifies that for the next 10 years, either I get it at a minimum or someone I designate as a beneficiary will get it for that time. And you can also set up what's called joint annuities, which says we're going to put $100,000. Now, for joint annuities, this typically has to be non qualified. So make sure you understand the tax implications for this. But in the example of my wife and
okay.
I, we could put 100,000 in an annuity that we're both the annuitants, and we'll both get that income as long as one of us is living. And that really also helps protect longevity on that side. But the income options and the number of annuitants does vary. If Christy, if you don't mind, I'd love to share with you. This is one idea that we have used with our clients that I think folks, it really kind of expands the creativity of what annuities can do. If we have,
Okay.
so most of
Yep.
us have received, I say most of us, but there are many of us that remember getting a birthday check from grandma. And grandma sends that birthday check every year. I have been fortunate. My grandparents, I've got a 94-year-old grandmother, and I had a 90-year-old grandmother and a 90-year-old grandfather. And every year, like clockwork, I always get my birthday card with usually like $50. Now, as a father of four, my wife and I know that's a lot. That doesn't go that far, that $50. But it's quite sweet that grandma sends it every single year. Well, the tough part is when grandma passes away, you know, the birthday checks are probably not going to come anymore. And one of the creative ideas that we've been able to do is what we call a birthday gift for life. And what that does is it
Mm,
provides a client that they are a joint annuitant with their grandchild or their child, whoever they want. And as they're that joint annuitant, as long as one of the two of them are living, it's always going to have a payout. So to put it really from the detailed side to the concept side, if my grandmother had done this and for all of her grandchildren, then every year for the rest of our lives, we would be getting that birthday check. I'm pretty excited that for all of my cousins, hopefully they're not watching this, they don't realize that they'll still be getting a birthday check every year because grandma had put aside this little birthday gift, and there'll always be a remembrance. It's a loving legacy piece, and that's where you really want to look. That annuities can actually create some very touching and memorable solutions beyond what just traditional investments or traditional accounts can do.
that is precious. Like, makes me tear up.
Uh,
Precious. Yeah, I would totally be like, as a person who's not a grandparent yet, that would be like right down my alley. I'd be like, yes, I want
it's,
to do
it's so
that.
exciting to think, next year, my grandmother recently passed this just earlier in December, and my birthday's coming up. And, for my cousins, I'm excited that next year, they don't realize it, but they're going to get that birthday check. And they're going to think, oh, that was just
Yeah.
inheritance. and the next year they're going to get it. If I live as long as my grandmother, and I'm 46, if I live till 90, I'm going to be getting birthday checks for the next 45 years. And the most touching part is I'll be 85 years old. I'll be getting a birthday check for, from grandma for about the same amount. But the benefit, I mean, I can only buy a gallon of gas probably at that point, but I'll never forget 45 years from now that grandma left me a touching memory. And it'll keep her and my grandpa always in my mind. So it's a very touching idea.
Yeah. Yeah. That's really cool, actually.
And that happens with
So,
annuities. Annuities are the unique structure that allow
yeah.
ideas like that to come to life.
Yeah. When you think about setting one up, okay, and so tell me, like, how much money does somebody need to get started with something like this? Is there a minimum? Can they just fund it monthly for a period of time? How does
Yeah,
that
that's a
work?
great question. Because annuities for them to be able to work and grow, do typically have minimums. Fortunately, it depends on the
Okay.
type of annuities. A single lump sum annuity might have a minimum of 25,000 or 50,000 just to get started. Some can start for lower amounts like 10 or 15,000. That grandparent gifting idea was actually a $10,000 minimum. But if you're going to do a single lump sum, usually those are the thresholds. They also have annuities that you can continue to add in, and those are called flexible premium annuities. And those might have a much lower threshold, just $1,000 a month, $2,000 a month, that allow you to grow money but continually contribute into the annuity. But I would say most folks typically, when you've saved up or accumulated, let's say $500,000 or $1 million of retirement savings, you might carve off 20 or 30% of that, meaning 200 to 300,000, and be repositioning that in an annuity solution to complement your retirement plan.
Got it. It's funny because when I first learned about annuities, it was actually through a documentary that was done called The Baby Boomer
Oh,
Dilemma.
really?
And it was probably 5 or 6 very high in the financial world folks, whether they did education, whether they were actually planners. Some of them were curriculum, folks. Some of them were compliance folks. They all were in some form of the financial industry. And they talked about what they personally did in their own retirements with annuities, which I thought was the most interesting part. It wasn't like, here's what you should do. It was, here's what I did. And I think that spoke to the change that you could see, because here are these people who are in the industry, who know the ins and outs, who are using this in their own personal financial plans. And that to me spoke volumes about, well, maybe this is something that, we should be paying attention to.
Absolutely. Interestingly enough, I ran across an article, I think it was about 2 or 3 months ago, where Shaquille O'Neal, most folks
Oh,
recognize that name. He was speaking about his experiences with a very wealthy individual, and the wealthy individual was giving him advice on kind of how to leverage, obviously, all of the wealth that Shaquille O'Neal was earning, both in the business world but also from his NBA career. But the shocker at the end of it was a voucher, kind of a heads up of he leveraged annuities, both the wealthy man and Shaquille admitting, I didn't know anything about annuities, and they're a great solution. So it's an interesting article that as you read it, you wouldn't expect it to make that turn, but sometimes
yeah.
those pieces where people share their own personal experiences with them and leveraging them have a much more powerful message than some arbitrary kind of, oh, this is where you feel like it's a sales pitch instead of someone sharing how they've been successful.
Yeah. And not to give any spoilers away if anybody wants to go watch this documentary, at the very end, one of the gentlemen had actually, the entire filming, he was pretty vulnerable and telling everybody he was struggling with cancer, and he passed before the documentary came out. and it talked about the annuities and what they were going to do for his wife after he passed. So I was like, when you think about, um, the value there and the potential and the power of that, it was certainly his legacy to his wife to take care of her.
A lot of times annuities, just like insurance, is bought not necessarily just based out of logic in itself, but also because of the emotional component that's tied to how do I
Yeah.
take care of the ones I love, and if this is a solution that allows me to do that, then I know that I've been able to do more beyond my time here, to both take care of and love those who mean the most to me.
So one more question that I can think of when you're talking with clients, and maybe, I mean, you as a financial advisor probably have a pretty good um, grasp on this person's ability to take care of their finances. Are there some more than others that you're like, I think an annuity is a great solution for this person because it slows down the spending of the bulk of their money, right?
Yeah, ultimately, no one likes to be told how to spend their money. But one of the biggest challenges is how do you save for retirement and save the right amount? The rule of thumb, of course, is that you should be setting aside 9 to 12% of your regular income for retirement. And the reason being is you're going to have a working career typically of age 25 to age 65, and that's 40 years. A lot of folks don't realize, especially as our life expectancy grows on, meaning we are living longer than we did 30, 50, 60 years
Yes.
ago, you might be retired for another 30 to 40 years from age 65 to 95 to 105. That money that you earn and that you save during those working years really has to last you another 40 years the rest of your life, because it's going to be very difficult to generate income as a 90-year-old, right? You can't necessarily be able to just jump out it back into the workplace. So I think that's one of the challenges is how do you both save the money but find ways that help support that. And annuities can offer features of being able to put that money aside and seeing it grow and giving you encouragement without having to worry about market fluctuations going up and down. So
Yeah.
I think that's part of saving is a behavior, and part of that behavior is attitude and mindset. And if there are tools or solutions that help reinforce or give you a positive experience, then a lot of times it can be even more encouraging to keep saving. So
Yeah, I agree. So Benjamin, if somebody's interested in learning more, because do you think just hearing you talk, this is going to be very specific to individuals? Yes, this is a good overview, but if they personally want to know more, how can they reach
absolutely.
you?
We'd love to be a resource to them. My firm, Audible Financial Group, we help clients just like your listeners with very custom tailored solutions for whatever their goals or their desires are. And the easiest way to reach us is just send us an email. Our email, my email directly is bgerald, BGERALD at audiblefg.com. And, or you can give us a call. Our main office line, and you can select any of our advisors, 972 200 3420. We'd love to sit down and meet with your clients and be a resource to them.
And I will, just put a plug out there for folks. If you're afraid of talking to a financial advisor, don't be.
Correct.
They're a lot of the nicest people, and I think it's so important. And, I'll have folks say to me, I don't have enough money to talk to a financial advisor. You do. And that's especially when you need to, so that you can figure out how to make that money last, because we are living longer as a people, and we need to be able to not outlive our money.
Absolutely. Absolutely. Well, thank you again for having me on the podcast. It's been a wonderful time, and I hope that this has been educational and also valuable for you and your community.
Yeah. Thank you.
Have a
Appreciate
wonderful
you.
day, Christy. I'll see you. Merry Christmas.
You too. Oh, thank you.